talk about how to define an index, how the calculations are done, how you construct one, how you manage them, what is the purpose and use of these indexes, right? And of course, we have indexes for stocks, for bonds, and for alternative investments such as real estate as well. So we'll talk a little bit about that too. Now, what is the purpose of this? You need to track the performance, right? And it's not just about tracking the performance. So let's say you are an investment manager, you get a client, and that client says, I want to invest in the US market, right? And you make a return for them. Let's say you take their $100 and you increase it, you invest it, and it goes to 120. The question is, have you done a good job or a bad job? Well, there has to be something which will indicate what the US market performance has been. So let's say if that is S&P 500 and the S&P 500 went up let's say 5% during that time. So then obviously you've done a fantastic job because you have got your portfolio that you're managing for your client has gone up 20%, right? So it's not just to to track the performance, but also to evaluate performance against a certain benchmark. So indicators which are a measure of something are basically not just serving as a tool to track the performance of that investable universe, right? So when we say something, what are we talking about? We're talking about investments, of course, and a certain universe of investments. That could be real estate, that could be bonds, that could be stocks. Within stocks, it could be US stocks. Within US stocks, it could be technology stocks, right? So for example, NASDAQ is for tech companies. S&P 500 is for all sectors, right? FTSE is for the UK. Nikkei is for Japan. So it could be for different asset classes, within that different geographies, different sectors. Objective being to track it and not just to look at the performance, but also to look at the volatility, which then tells us about the risk that, okay, the S&P 500 has been going up, but it crashes as well, right? March 2020, COVID lockdown. How do you know that the market crashed? You look at the S&P 500 and say, oh, the market crashed. Or you look at a broad market index like Russell 5000. Now, S&P 500 has 500 companies inside it. Russell 5000 has 5,000 companies inside it. So we look at narrow indexes, broad indexes, right? So again, what are we talking about? It measures the value of different target markets or investable universe. Within that, it could be stocks, bonds, real estate, right? So security markets. Within that, you can have multiple different segments. You can have this for different asset classes. So that is the higher level introduction for what is an index. Think of it like a basket, right? And if you're putting in 500 stocks in this basket, and these are the biggest 500 companies in US, well, then this basket would be called S&P 500. And what these companies are called are the constituents of this index, right? These are the constituent securities. Now, of course, when you buy the S&P 500, two things happen. You get a price return. So let's say you bought it at 1,000 and it went to 2,000, right? So of course, your money doubled. But during that time, you might have received a lot of dividends as well from those companies. Now, first of all, you can't really buy the index. Index is there to track, but there are funds and ETFs which track these indexes. So for example, for S&P 500, a very famous ETF is SPY. So when you buy a unit of SPY, what's happening inside that unit is it is taking your money and dividing across the 500 companies that are there in the index, because it's tracking the index. And when it's buying all those companies and the company's stock prices are going up, so the value of the index is going up and the value of this unit goes up as well. And not only that, the dividends that these companies are paying, SPY will pay to you in whatever share your part of the investment is. So not only do you have a price return, you also have an income return, and when you combine the income return with the price return, you get the total return. Now, how do you calculate the price return? It's very simple. It is the ending value of the index, right? So this is the ending value of the index minus the beginning value of the index divided by the beginning value of the index. If you add income or the dividend you're getting during that time, then you get your total return. This is for one period, right? A single period. So let's say 2022 to 2023, you earned 15%. But then 2023 to 2024, you earned, let's say, 12%. Now the point is, can you just add 15 and 12 to find out what did you make from 2022 to 2024? The answer is no. You have to add them like this. So if I wanted to add 16% to 11% to minus 4%, I would first add 1 to 16%, right? So that's where this 1.16 is coming from. And instead of adding them together, I would multiply the 11% as 1 plus 0.11, and then again multiply with 1 plus, and then of course it's minus 0.04, so it becomes 0.96, right? And you multiply all of these together, and this will give you, so let's say if you're starting with a $100 investment, then whatever the starting value is will give you the ending value. So this is how you put together multiple periods return. And then if you want the average for, let's say, if this is 3 years, you want the average, you can just do under root 3 or to the power of 1 over 3. And that's how you calculate a compound annual growth rate, also called geometric average. This is something you've seen in your quants material, right? So multiple periods, this is how we link the returns. Now, how do you go about constructing an index? Obviously, you know what is you need to know what is the investable universe it's going to track, right? What is it representing? Right, so what is the target market? Is it stocks? Is it bonds? Is it real estate? Right, and then let's say if it's stocks, and then it's US stocks, and even within US stocks, let's say it's technology stocks, right? So if it's NASDAQ 100, so you're putting 100 different companies or constituents in that. The question is, does every company get an equal weight, or are we going to give more weight to bigger companies like, let's say, Apple, Google, Microsoft, Amazon, and lesser weight to relatively smaller companies, let's say like Netflix, right? So I mean, Netflix is also a big company, but compared to Apple, Google, Microsoft, Amazon, it is a relatively smaller company. So how much weight should we give it to each of these constituents? Should we give them equal? Should we give them based on their size? Should we give them based on not their size, but in terms of their revenue or cash flow? Right? So this is what this whole reading is going to be mainly concentrating on, is the weight that we have to give to each security. So that's the bulk of this reading. And then let's say you give them all equal weights, right? But then Netflix goes up more than others. So obviously then you have to rebalance them. You'll have to sell some of the Netflix stocks and buy some of the other ones to make sure that they are equalized again, right? So this is rebalancing. And then maybe some company closes down, another new company comes up. So then obviously you have to take one out, add the other one, right? So you have to re-examine their selection, and of course the weighting is re-examined in the rebalancing as well. So this selection re-examination is called reconstituency. So you have rebalancing and reconstitution. Now all of this can be at a broad level. So think of Russell 5000 stocks. It could be narrow. So think of S&P 500 stocks. Even narrower, just technology companies, NASDAQ 100, right? But it's very, very important that you're very clear about the investment universe it is tracking, and the securities are selected accordingly. It could be based on the asset class, this, let's say stocks, US stocks, so geographic region, and then other characteristics like technology companies. So that comes to NASDAQ 100. Now this is the bulk of the reading, that how are you going to assign the weight to each of those different securities. So let's take a break here, get fresh, and then come back and we'll jump into the core of this reading, which is the different weighting schemes.